Today, we are going to pull back the curtain on a financial tool that's built for one very specific job, creating a paycheck in retirement that you can count on. It's the Ceres Life Graybar IncomePlus annuity. So let's dive in and see how it works, what it's promising, and who it might actually make sense for.
All right, here's our game plan. First, we'll talk about the big retirement problem this whole product is trying to solve. Then, we'll look under the hood at its growth engine and the main event, the lifetime paycheck feature. And finally, we'll get real about the trade-offs to help you figure out if this is something that even fits your world.
Okay, before we get into the nuts and bolts of the product itself, let's start with the why. Why does something like this even exist? Well, it's all about tackling what we call the retirement income puzzle.
I mean, this is it, right? This is the one question that keeps a lot of people up at night. You've worked your whole life to build this nest egg. Now what? How do you make sure that money lasts as long as you do? You're dealing with two huge unknowns: how long you're going to live and what the market is going to do. That fear, the fear of outliving your money, is exactly what this is all about.
So, what's the proposed solution to this puzzle? Well, the engine inside the Graybar IncomePlus is what's known as a fixed indexed annuity. Let's break down what that actually means.
You know, the easiest way to think about this is as a contract. It's an agreement you make with an insurance company that tries to give you a bit of a safety net with a shot at growth. You get a floor, which means your principal is protected from market losses, but you also get a connection to the market's potential upside, so you have a chance to earn interest when things are going well. It's really built on three main ideas. First, and this is a big one, principal protection. Your money is shielded from direct market drops. Second, index-linked growth. Your potential gains are tied to how a market index performs. And third, the optional lifetime income. This is the ability to basically flip a switch and turn on a paycheck that you can't outlive.
So here's how that works in simple terms. Let's say the annuity is linked to the S&P 500. If the S&P has a good year, great, you can earn some interest. But what if the market has a terrible year and goes down? Well, you just get a zero. You don't lose your principal due to that market drop. The whole idea is to capture some of the upside while completely avoiding the direct downside.
Now we get to the main event. This is the feature that honestly is the reason most people look at these products in the first place: the ability to create your own personal pension. It's an optional add-on called a rider, and this one is a guaranteed lifetime withdrawal benefit. Okay, to understand this income part, you have to get your head around one very important term: the benefit base. This is probably the single most misunderstood part of these annuities. The best way to picture it is as a calculation account. It is not real money. You can't just take it and walk away. Its one and only job is to be the number the insurance company uses to figure out how big your guaranteed paycheck is going to be for the rest of your life. So one way they make this feature really attractive is by giving that benefit base a boost right from day one. The brochure, for example, shows a potential 20% upfront bonus. So what does that mean? It means if you put in $100,000, your calculation account for that future income could immediately jump to $120,000. It gives your future paycheck a pretty nice head start.
And this right here, this slide, is the whole ballgame. If you understand this one distinction, you understand how these things work. On the left, you've got your accumulation value. That's your real money, your cash. On the right, you have the benefit base. That's the calculation number we just talked about. They are two totally separate things, and confusing them is where people can get into trouble. Of course, a guarantee like this doesn't come for free. There's a cost. The brochure points to an annual rider fee of around 1.10%. Now, it's really important to see how this fee works. The percentage, that 1.10%, is applied to that bigger benefit-based number, but the actual dollars are taken out of your real money, the accumulation value.
All right, we've seen the potential benefits, so let's flip the coin over and talk about the trade-offs. It is absolutely crucial to understand that these are long-term contracts, and they come with a very specific set of rules.
Think of these as the guardrails of the contract. If you need to pull out a big chunk of money in the early years, usually more than 10% in a year, you're likely going to face some surrender charges. And while your money grows tax-deferred, which is a nice perk, taking it out before you're 59.5 could mean a penalty from the IRS. See, every rule is there to reinforce that this is a long-term retirement tool, not a savings account.
And hey, don't just take my word for it. The source material itself is super clear on this. It says it's probably not a good fit for people who need easy access to their cash, have short-term goals, or are trying to get aggressive, uncapped market growth. If you need your money to be liquid, this is just not the right tool for that job.
So with all that said, who is this actually for?
Let's put all the pieces together and see what kind of person might find this valuable.
On one side, you have the person this is really designed for, someone whose top priority is safety and a predictable income stream. Maybe they want to create a reliable income floor to make sure their essential bills, like the mortgage and utilities, are always covered in retirement no matter what. It's really built for the safe part of your portfolio, not the growth part. So at the end of the day, the question isn't really whether this annuity is good or bad. The real question is much more personal. Does its core mission to create a protected income floor for your retirement fit with your specific financial goals and your overall strategy? And really, that's the most important thing for you to figure out.